Who called the Fed? When silver hit $80. Emergency exposed. December 27th, 2025. While you were sleeping, silver didn't just rise, it exploded 10.2% in a single night, hitting $79.31 per ounce, triggering emergency alerts across every major bank in New York, London, Hong Kong. But here's what they're not telling you. 4 days later, China slammed a door shut, cutting off 60 to 70% of the world's silver supply overnight. The question isn't why silver moved. The question is, who knew it was coming, and why did someone place an emergency call to the Federal Reserve before the rest of the world even woke up? Welcome to Financial Announcement, where we decode the economic events that reshape your financial future before the headlines catch up. Now, if you've been navigating markets long enough to remember when information came from newspapers rather than notifications, when due diligence meant reading quarterly reports cover to cover, then you understand the value of seeing around corners before the crowd arrives. Do me a favor. If this kind of strategic intelligence matters to you, press that subscribe button, not because everyone else is doing it, but because you recognize that in markets, early information is the only information that matters. And tell me, where in the world are you watching this from right now? Are you monitoring this from New York, London, Singapore, or somewhere the financial establishment hasn't mapped yet? Drop your location in the comments, because what I'm about to walk you through affects every single market, every currency, every supply chain on this planet. Let's begin. The trading floors were quiet that night, December 27th, 2025. Most analysts had already logged off, celebrating what remained of the holiday week, their screens dark, their risk models dormant. But at 2:47 a.m. Eastern Standard Time, something extraordinary began to unfold in the silver market. The price didn't climb, it detonated. Within 6 hours, silver surged from $71.89 to $79.31 per ounce. A 10.2% vertical move that sent automated risk alerts screaming across every major trading desk from Manhattan to Hong Kong. For context, precious metals don't move like this. Gold might drift up 2% on geopolitical tension. Silver might edge higher on industrial demand forecasts. But 10% overnight, that's not a market adjustment. That's a stampede. Senior traders arriving at their desks that morning found something they hadn't seen in decades. Every resistance level on their technical charts had been obliterated. Every stop-loss order triggered, every hedging strategy suddenly underwater. One veteran commodities analyst at a major London bank later described it simply, the metal moved like someone had just yelled fire in a crowded theater. But here's what separated this move from ordinary volatility. There was no news event, no geopolitical crisis, no central bank announcement, nothing in the headlines to explain why billions of dollars were suddenly flooding into silver futures. The professional money managers, the institutional traders who move markets with their allocation decisions, they were asking the same question that morning. What do they know that we don't? Because when metals move this violently, this fast, it's never speculation driving the action. It's information. Or, more precisely, it's someone acting on information the rest of the market hasn't processed yet. The answer sat exactly 4 days away. January 1st, 2026, a date circled in red on certain desks in Beijing, Shanghai, and a handful of Western trading operations that pay attention to Chinese regulatory filings. On that date, China would implement export controls that would fundamentally restructure the global silver market. Not modest policy adjustments, not bureaucratic paperwork requirements, but a complete lockdown of supply chains that the world had taken for granted for decades. The official documentation from Chinese customs authorities spelled it out clearly. Any company wanting to export silver from China after New Year's Day would need to meet two non-negotiable requirements: annual production capacity of at least 80 tons and credit lines of 30 million or more. Those numbers might sound technical, bureaucratic even, until someone runs the calculations on who gets excluded. Between 60% and 70% of the world's silver supply flows through Chinese mining operations, refining facilities, and export channels. The Chinese government had just erected a wall that would block the majority of global supply from reaching international markets. Think about that for a moment. Imagine if tomorrow, a single country controlled 70% of the world's oil supply and announced that only the largest corporations with massive financial backing could access it. That's exactly what was about to happen in the silver market. But unlike the 1970s oil embargo, when Americans sat in gas station lines and evening news broadcasts showed the chaos in real time, this crisis was unfolding in the shadows of the financial system. No headlines, no press conferences, no public awareness. Just a price spike at 2:47 a.m. that told certain traders everything they needed to know. Someone had connected the dots before everyone else. Someone understood that in 4 days, the physical silver market would face a supply shock unprecedented in modern commodity history. And someone had already begun positioning for what came next. The question haunting trading floors that morning wasn't about the price anymore. It was about who saw this coming, who had access to information about Chinese regulatory changes before they became public, and most critically, who picked up the phone and called the Federal Reserve to warn them that the silver market was about to break. Because when metals move like this, when billions of dollars shift in the darkness, when supply chains face restructuring that will ripple through every industry from solar energy to electronics manufacturing, central banks don't stay silent. They just don't announce their involvement until long after the crisis has passed. The document appeared on January 2nd, 2024. Not January 1st, not the day the regulations officially took effect, but the day after, when it was already too late to respond. China's General Administration of Customs published the new export licensing requirements in a dense 47-page policy directive, buried on page 31, in technical language that most commodity traders wouldn't bother reading until their shipments started getting blocked at ports. By then, the damage was done, but some organizations had seen this coming months earlier. In August 2024, a small group of commodity intelligence analysts at a private research firm in Singapore noticed something unusual. Chinese mining companies were suddenly consolidating. Smaller operations were being absorbed by state-backed enterprises at rates that didn't match normal market conditions. In September, refining facilities in Guangdong province began rejecting third-party contracts, citing regulatory preparation requirements that didn't exist in any published government documentation. In October, export volumes from Chinese ports began declining, not dramatically, just 3% to 5% month over month. The kind of statistical noise that gets lost in quarterly reports unless someone is specifically watching for it. Someone was watching. By November, certain trading desks had quietly begun accumulating physical silver positions, not through the paper contracts that dominate COMEX trading, but through actual metal purchases, coins, bars, industrial-grade inventory sitting in private storage facilities. They understood what was coming. The 80-ton annual production threshold wasn't arbitrary. It was surgical. According to industry data, approximately 400 silver mining and refining operations in China produce less than 80 tons annually. These smaller facilities collectively account for roughly 35% of China's total silver output. With one regulatory requirement, they were eliminated from export markets. The $30 million credit line requirement finished the job. Even medium-sized operations that could meet production thresholds couldn't maintain credit lines of that magnitude. Not in an industry where profit margins run thin and commodity price volatility makes banks nervous about extending large credit facilities. The result? Approximately 60% to 70% of global silver supply, cut off from international markets overnight. But here's where the strategy gets more sophisticated. China didn't ban silver exports. They restricted who could export, which meant they maintained compliance with World Trade Organization rules while effectively controlling supply. It's the same playbook they used with rare earth elements in 2010, with tungsten in 2015, with gallium and germanium in 2023. Control the choke point, control the market, control the price, and silver isn't just a precious metal that investors buy for portfolio diversification. It's the invisible metal that runs modern civilization. Every solar panel requires approximately 20 grams of silver. Every smartphone contains 0.3 grams. Every electric vehicle uses between 25 and 50 grams depending on the model. Medical equipment, water purification systems, military electronics, all dependent on steady silver supply. When China announced those export controls, they weren't just reshaping precious metals markets. They were putting their hand on the throat of the global technology supply chain. European solar manufacturers suddenly faced raw material uncertainty just as the continent was accelerating renewable energy installations. American electronics companies watched their just-in-time inventory models collapse. Japanese automotive suppliers began scrambling for alternative sourcing that didn't exist at scale. The physical market reacted exactly as expected. COMEX inventories, the registered silver stored in exchange-approved warehouses, had already been declining since 2020, down 70% from peak levels. Now, with Chinese supply restricted, that remaining inventory became critical, except there was a problem. The paper market, where traders exchange contracts representing silver they may never actually possess, had grown exponentially larger than the physical market. For every ounce of actual silver sitting in a vault, there were approximately 250 paper claims on that same ounce. It's a system that works perfectly until everyone tries to collect at once. And in late December 2025, certain institutional players started doing exactly that, demanding physical delivery on contracts that the market assumed would just roll over into the next month, the next quarter, indefinitely into the future. Suddenly, the dealers who sold those contracts, the banks who facilitated the trades, the clearinghouses who guaranteed settlement, they were all staring at the same nightmare scenario. What happens when paper promises meet physical reality? and there isn't enough metal to go around, that's when phones started ringing in Washington. That's when the real emergency began. The call didn't come through official channels, no press release, no Federal Reserve Board meeting minutes, no testimony before congressional committees. But on December 28th, 2025, less than 24 hours after silver's explosive overnight move, 3 senior executives from major bullion banks arrived at the Federal Reserve Bank of New York. Not at the main entrance on Liberty Street where tourists take photographs, but through the underground entrance on Maiden Lane, the one connected directly to the vault levels 5 stories below Manhattan, where the real conversations happen when markets break. They didn't stay long, 90 minutes at most. But when they left, certain things began happening in the silver market that couldn't be explained by normal trading activity. The futures curve inverted. For those unfamiliar with commodity markets, that's a technical way of saying that silver for immediate delivery became more expensive than silver promised for delivery months in the future. In a functioning market, that shouldn't happen, because traders would simply buy the cheaper future contracts, wait for delivery, and sell at the higher spot price, pocketing the difference. But this wasn't a functioning market anymore, because the traders who tried that arbitrage discovered something disturbing. They couldn't get delivery. One mid-sized hedge fund in Connecticut placed an order for 50,000 ounces of physical silver on December 29th. Standard procedure, routine transaction, they'd executed dozens of times. Their dealer, a reputable firm they'd worked with for 8 years, called back 6 hours later with an apologetic message. We can't source that volume right now. Maybe February, maybe March. February or March, for a metal supposedly sitting in warehouses waiting to be sold. The fund manager made 3 more calls, same story. Then 5 more calls, same story. By the end of the day, he understood what was happening. The physical metal had disappeared from the market, not because it didn't exist, but because the institutions that controlled it had stopped selling. They were hoarding. And when major financial institutions start hoarding a commodity while simultaneously reassuring the public that everything is fine, that's when central banks get involved. The Federal Reserve doesn't directly trade commodities. They don't set silver prices. They don't manage physical inventories, but they do manage systemic risk. And what was emerging in late December 2025 was a textbook systemic risk scenario. A handful of bullion banks had sold far more silver contracts than they could possibly deliver. Those contracts were coming due, and the Chinese supply shock had eliminated their ability to source metal to fulfill obligations. In banking terms, this is called a delivery squeeze. In plain language, it's a bank run, except instead of depositors lining up for cash, it's contract holders demanding metal that doesn't exist. The derivatives exposure was staggering. According to data from the Office of the Comptroller of the Currency, 3 major U.S. banks held approximately $47 billion in notional silver derivatives positions as of the third quarter of 2025. Notional value doesn't mean they lose $47 billion if silver prices moved, but it does mean their counterparty risk, their settlement obligations, their collateral requirements, all tied back to their ability to deliver or receive physical metal at agreed prices. When Chinese export controls severed 60% to 70% of global supply, those carefully constructed hedging strategies became worthless. Worse, they became liabilities, because now these banks faced a choice: default on delivery obligations and face legal action from counterparties, or buy physical silver at any price necessary to fulfill contracts, driving prices even higher, potentially triggering margin calls across the entire precious metals complex. Either option threatened to cascade through the financial system. The Federal Reserve had seen this movie before. In 1980, when the Hunt brothers tried to corner the silver market, prices spiked to $49 per ounce before regulators intervened, changed margin requirements, and collapsed the scheme. In 2008, when Lehman Brothers failed, the problem wasn't just one bankrupt institution. It was the web of derivative contracts and counterparty obligations that threatened to take down the entire system. This time, the catalyst wasn't market manipulation or subprime mortgages. It was geopolitical supply control colliding with over-leveraged paper markets. And the Federal Reserve's response followed a familiar pattern: public silence, private coordination, strategic liquidity provision through channels that wouldn't appear in official documentation for months or years. On December 30th, the Fed's emergency lending facility, the one established during the 2020 pandemic and supposedly wound down, quietly expanded its collateral acceptance criteria to include certain commodity-backed securities. No announcement, just an updated technical document on the New York Fed's website that financial journalists wouldn't notice until someone pointed it out weeks later. Translation: banks facing delivery squeezes could now borrow directly from the Federal Reserve, using their silver positions as collateral, giving them breathing room to manage the crisis without triggering defaults. On December 31st, the Commodity Futures Trading Commission issued a staff advisory, reminding market participants about position limit rules and settlement procedures, bureaucratic language that essentially told traders, don't push this, don't force delivery, let the contracts settle in cash if necessary. By January 2nd, when Chinese export controls officially took effect, the immediate panic had been contained, not resolved, contained. The banks weren't going to default, at least not immediately. The paper market would continue functioning, at least nominally. But everyone involved understood the reality. The silver market had fundamentally broken, and someone, somewhere, had warned the Federal Reserve early enough that they could prepare, which raised the most dangerous question of all. Who had that level of intelligence, that degree of access, that kind of advance warning about Chinese regulatory policy? And what did they demand in exchange for making that call? The memo circulated on January 6th, 2026, not through official government channels, not through mainstream financial media, but through a private intelligence network that serves approximately 200 institutional clients worldwide. The subject line read simply, Silver. The canary stopped singing. Inside, 12 pages of analysis that most business leaders would never see, documenting something far more significant than a commodity price spike. What happened in silver wasn't an isolated event. It was a demonstration, a proof of concept, a preview of how resource control would be weaponized in the emerging economic order. Because here's what the sophisticated players understood immediately. If China could restructure global silver markets in 4 days with a 47-page regulatory document, what else could they control with similar mechanisms? Cobalt, essential for battery production, 70% of global supply flows through Chinese refining operations. Rare earth elements, critical for everything from wind turbines to military guidance systems. China controls 90% of processing capacity. Gallium and germanium, semiconductor materials that enable modern computing. China dominates global production. The silver shock wasn't about silver. It was about demonstrating control over the invisible materials that make technology possible. And the business leaders who understood this first, who recognized the pattern before it became obvious, they began making decisions that would define competitive advantage for the next decade. Within 2 weeks of the Chinese export controls taking effect, 3 separate corporate strategy shifts emerged across different industries. First, the procurement revolution. Companies that had spent 40 years optimizing for just-in-time inventory, minimizing storage costs, relying on global supply chains to deliver materials exactly when needed, they reversed course overnight. A major German automotive manufacturer quietly secured a 12-month forward contract for silver at $82 per ounce, locking in supply at what seemed like an elevated price. By March 2026, when spot prices hit $94, that decision looked brilliant. But it wasn't about the price. It was about guaranteeing access, ensuring production lines wouldn't halt because critical materials became unavailable, accepting higher costs today to prevent catastrophic disruptions tomorrow. Other manufacturers followed, building physical inventories of strategic materials that previously lived only on spreadsheets as accounting line items. The era of inventory minimization was over. The era of strategic stockpiling had begun. Second, the diversification scramble. Supply chain managers who had optimized for Chinese efficiency, lowest costs, fastest turnaround, suddenly found themselves explaining to boards of directors why 70% of their critical materials flowed through a single geopolitical choke point. New projects launched across 4 continents. Australian mining companies received investment commitments they'd been seeking for years. Suddenly viable, now that strategic necessity overrode pure economic calculation. Canadian refiners began expansion projects. Mexican processing facilities attracted capital. Even deposits in Montana and Idaho that seemed economically marginal became strategically essential. But here's the reality these companies discovered. Building alternative supply chains takes years, not months. Permitting, environmental reviews, construction, equipment installation, workforce training, refining processes, quality control, distribution networks. The companies moving fastest might have meaningful alternative capacity by 2028 or 2029. Until then, they remained dependent on the very supply chains they were trying to escape. Third, the financial repositioning. Institutional investors who traditionally viewed commodities as portfolio diversification, a small allocation to hedge against inflation or currency devaluation, they fundamentally reassessed the role of physical materials in strategic planning. Private equity firms began acquiring physical storage facilities, not as real estate investments, but as critical infrastructure for commodity holdings. Family offices increased physical precious metals allocations from 3% to 15% of portfolios, not for speculative returns, but as insurance against supply disruptions. Pension funds, traditionally prohibited from significant commodity exposure, began lobbying regulators for expanded mandates, arguing that resource security had become a fiduciary responsibility. The financial architecture was shifting from paper claims to physical control. But for every company that adapted quickly, dozens more remained dangerously exposed. The solar industry faced immediate crisis. Manufacturers who'd built business models around Chinese silver supply suddenly couldn't source materials at any price. Projects delayed, installations postponed, renewable energy targets pushed back years. The electronics sector confronted similar challenges. Smartphone production slowed. Automotive electronics became bottlenecks. Medical device manufacturers rationed silver components, prioritizing critical care equipment over routine applications. The gap between those who saw this coming and those who didn't widened into a competitive chasm. And that raises the critical question for every business leader watching this unfold. What other supply shocks are building right now, hidden in regulatory documents nobody's reading, visible only to those paying attention? Because the pattern is clear. Resource control has become the primary tool of geopolitical competition. Not military force, not diplomatic pressure, but quiet regulatory changes that restructure global supply chains before most people realize what's happening. The executives who visited the Federal Reserve on December 28th understood something crucial. They weren't there to prevent the crisis. They were there to ensure their institutions survived it while others didn't. That's not cynicism. That's reality. In markets, as in nature, survival belongs to those who adapt fastest to changing conditions. The silver shock of December 2025 sorted companies into two categories: those who had intelligence networks capable of seeing around corners, and those who read about crises in news reports after the damage was done. The question every business leader must answer now: which category does your organization belong to? Because the next supply shock is already building. The only question is whether you'll see it coming, or whether you'll be making emergency calls when it's already too late. The Federal Reserve can contain financial system risks, but they can't source physical materials that don't exist. And they can't protect companies that failed to prepare for a world where resource access determines competitive survival. The age of abundant materials and frictionless global supply chains, that age ended on January 1st, 2026. Most people just haven't realized it yet.